There's a loan you've been paying for 30 years and nobody ever told you about it. It's not on your mortgage statement. It's not in your 401k disclosures. Your financial advisor has never mentioned it because most of them don't fully understand it either. But every time interest rates stayed low when they probably shouldn't have, every time the stock market bounced back faster than it had any right to, every time your home value climbed while wages stayed flat, that loan was working in the background, silently. For 30 years, it came from Japan, and in the last 18 months, it started ending. I want you to sit with that for a second, because the people who run money for a living have been watching this quietly, and they're not panicking. But they're moving. They're repositioning. They're having conversations behind closed doors that you and I were never invited to. Meanwhile, the average American over 50, with a 401k, a paid-down mortgage, and maybe 10 or 15 years until retirement, has no idea that the financial weather is changing under their feet. This isn't a crash video. I'm not here to scare you, and I'm not selling gold. What I'm going to show you tonight is the actual mechanism, the plumbing, of how cheap money from one small island nation quietly subsidized your retirement math for 3 decades, and what happens to that math now that the spigot is closing. Some of it is unsettling. Some of it is, honestly, manageable if you understand it in time. But here's what I can promise you. By the end of this video, you'll see the financial world differently. You'll understand why your bond funds have been acting strangely. You'll understand why mortgage rates aren't coming back to where they were. You'll understand why your advisor keeps saying, "We're in a new regime," without ever explaining what that means. And most importantly, you'll know what to do about it. Let me show you the blueprint. To understand what's ending, you have to understand what began. And to understand what began, we need to go back to a country most Americans haven't thought about seriously since the 1980s. In 1989, Japan was on top of the world. Tokyo real estate was so expensive that the land under the Imperial Palace was reportedly worth more than the entire state of California. Japanese companies were buying Rockefeller Center, Pebble Beach Golf Course, Columbia Pictures. American business magazines ran cover stories asking whether the U.S. had already lost the economic race. If you were alive and paying attention back then, you remember the mood. It felt inevitable. And then it broke. The Japanese stock market peaked in December 1989, and over the following years it lost more than half its value. Real estate followed. Banks were sitting on portfolios of loans backed by collateral that was suddenly worth a fraction of what it had been. And here's where Japan made a choice that would quietly reshape global finance for the next 3 decades. Instead of letting the banks fail and the system reset the painful way, Japan kept them alive. They lowered interest rates, then they lowered them again, then again. By the late 1990s, the Bank of Japan was charging essentially nothing to borrow money. By 2016, they went further. They introduced negative interest rates, which is exactly as strange as it sounds. The bank was paying you, in effect, to take money off their hands. Now, here's where you need to pay attention, because this is where most people get it wrong. They hear Japan has low interest rates, and they think it's a story about Japan. It isn't. It's a story about the entire global financial system, including the value of your home, the performance of your retirement account, and the rate on the mortgage you may have refinanced in 2020 or 2021. Here's why. When one of the largest economies in the world offers you money at essentially 0%, professional investors do something very logical. They borrow it in yen, and then they take that borrowed money and they convert it into dollars or euros or Brazilian reais or Australian bonds or American tech stocks or commercial real estate in Dallas or anywhere else in the world where the return is higher than zero. They call this the carry trade. The name doesn't matter. What matters is the scale. For roughly 3 decades, trillions of dollars, and estimates vary wildly, but most serious analysts put it somewhere in the multi-trillions, flowed out of Japan into global assets. That money didn't just sit there. It bought things. It bought stocks, which pushed the S&P 500 higher than fundamentals alone would have justified. It bought bonds, which kept long-term interest rates lower than they should have been. It bought real estate, including American real estate, which is part, not all, but part, of why your home in Phoenix or Charlotte or Tampa is worth 2.5 times what you paid for it. Now imagine you're 56 years old. You bought your house in 2009 at the bottom of the financial crisis for $280,000. Today it's worth $640,000. You feel, understandably, that you made a smart decision, and you did. But here's the honest part. Most people won't say out loud. A meaningful portion of that gain wasn't because you chose well. It was because cheap money from Japan and from other central banks that followed the same playbook lifted nearly every asset in the developed world at the same time. A rising tide. You happen to own a boat. I'm not telling you this to take anything away from you. You earned what you have. You worked. You saved. You didn't sell in 2010 when everyone was scared. That matters. But if you don't understand the tide, you won't understand what happens when the tide goes out. And the tide is going out. In January of 2025, the Bank of Japan raised its key interest rate to 0.5%, the highest it had been in 17 years. That sounds like nothing, half of 1%. In American terms, it's a rounding error, but the direction is what matters. After 30 years of going down, then sideways, then slightly negative, the world's largest cheap money factory has officially turned the dial the other way. And in May of 2026, Japanese long-term bond yields hit levels we haven't seen in a generation. This is the part where the story stops being about Japan and starts being about you. Because when the carry trade reverses, when investors who borrowed in yen at 0% suddenly have to pay more to borrow, or worse, have to unwind their positions and send that money back home, the assets they bought have to be sold. Stocks, bonds, real estate exposure, and the cheap financing that quietly supported asset prices across the developed world for 30 years starts becoming expensive financing. You don't need more money, you need a better plan. And the plan starts with seeing what's actually happening, not what the financial news tells you is happening. In the next section, I'm going to show you exactly how this reversal touches your portfolio. Specifically, why your bond funds have been losing money in a way your advisor probably hasn't fully explained, and why the standard 60-40 retirement portfolio that worked for 40 years may be working against you in the next 10. Open your most recent 401k statement. Specifically, look at the bond portion, the part that's supposed to be the safe part. The part your advisor put you in because, quote, You're getting closer to retirement, so we're shifting towards stability. If you've been paying attention over the last 3 or 4 years, you've noticed something that doesn't make sense. The bonds, the safe part, have been losing money. Not a little. In some periods, more than the stocks lost. And nobody you talk to seems to have a clean explanation for why. This is where most people get it wrong. They assume it's a temporary glitch, a bad stretch. They tell themselves bonds will come back the way they always have. And I understand why they believe that, and because for 40 years, from roughly 1981 to 2021, bonds did come back. Every time interest rates spiked, they eventually came down. Every time bond prices fell, they eventually recovered. An entire generation of financial advisors, including some who are managing your money right now, built their careers on that pattern. But that pattern had a hidden engine, and the engine was running on Japanese fuel, among other things. Let me explain the mechanics, because this is the kind of thing the financial industry assumes you can't handle, and I'm going to assume the opposite. A bond is just a loan. When you buy a 10-year Treasury bond at 4%, you're loaning the U.S. government money for 10 years, and they're paying you 4% a year. Simple enough. But here's the part that catches most people. The price of that bond on the open market moves up and down every single day, depending on what new bonds are paying. If new 10-year treasuries start paying 5%, suddenly nobody wants your 4% bond at full price. So your bond's market value drops. That's why your bond fund, which holds thousands of these bonds, shows a loss when interest rates go up. The bonds themselves are fine, they'll pay what they promised, but their resale value drops in the meantime, and if your fund has to sell some, or if you have to sell shares of the fund, you eat that loss. Now here's the connection to Japan that almost nobody is making out loud. For 30 years, Japanese institutional investors, pension funds, life insurance companies, banks were among the largest buyers of American Treasury bonds in the world. As of recent data, Japan holds roughly $1.13 trillion in U.S. government debt. That's not a typo. One country holding more than $1 trillion of our IOUs. Why did they do it? Because Japanese bonds paid them essentially nothing. American bonds paid them 3, 4, sometimes 5%. Even after currency hedging costs, it was a better deal. So Japan kept buying, and buying, and buying for 3 decades. When a major buyer that big keeps showing up at the auction, it does something specific to prices. It keeps yields lower than they would otherwise be. In plain English, the U.S. government got to borrow more cheaply than the raw economics of our debt would justify because Japan was helping fund us, quietly, reliably, year after year. Now imagine you're a Japanese pension fund manager in 2026. You're sitting at your desk in Tokyo. For the first time in 17 years, your own country's 10-year bonds are paying you something meaningful. Your own country's 30-year and 40-year bonds are at levels you haven't seen in a generation. The Japanese 40-year yield recently traded above 4%, and on top of that, the yen has been weak, which means every dollar of American bonds you own is exposed to currency losses when you eventually bring the money home. What do? You start sending the money home. You don't dump everything on Tuesday, that would be reckless. But you let your treasury bonds mature, and you don't reinvest the proceeds in more treasuries. You buy Japanese bonds instead. Over months, over quarters, the flow reverses. And the US government, which has been quietly enjoying a bid from Japan for 30 years, suddenly has to find new buyers and offer them a higher yield to show up. This is part of why mortgage rates didn't come back down the way everyone expected. It's part of why the standard 60-40 portfolio, 60% stocks, 40% bonds, had its worst year in nearly a century in 2022 and has been wobbling since. The diversification math that worked for 40 years assumed that when stocks fell, bonds would rise. That assumption broke, and it broke partly because the global plumbing of who buys what, from whom, at what price, started shifting. Now, I want to be honest with you about something, because this channel doesn't do prophecy. There are real cushions in the system. Japan still holds enormous amounts of US debt. The Bank of Japan still owns a huge share of its own bond market and can slow the adjustment. The Federal Reserve is not powerless. And there are other buyers, domestic American institutions, foreign central banks, private investors, who will step in at the right price. The system doesn't break overnight. What changes is the price. But here's what every American over 50 needs to internalize. The price of safety has gone up. Bonds aren't broken, but they're no longer the automatic counterweight they were for your parents' generation. The 40-year tailwind that made conservative investing easy has turned, and it's now at least a crosswind, possibly a headwind for the next decade. So what do? Let me give you a specific example. Imagine a couple, 58 and 60, with $720,000 in retirement assets, split roughly 60-40, about $432,000 in stocks, $288,000 in bonds. Their advisor told them this was the age-appropriate mix. Under the old regime, they could reasonably expect that bond portion to throw off steady, predictable income with low volatility. Under the new regime, that same allocation may behave more erratically, losing value when rates spike, recovering slowly, and earning real returns after inflation that are thinner than the historical models suggest. That doesn't mean they need to panic sell anything. It means the assumptions inside their retirement projection software, the software the advisor is using to tell them they're on track, were built on the old world. If you fix this assumption, everything changes about how you plan the next 10 years. In the next section, I want to take you somewhere uncomfortable but necessary. The question of what happens to the U.S. housing market, and specifically your home equity, when the global cost of money resets. Because if you're like most Americans over 50, your house isn't just where you live. It's the single largest financial asset you own. And the story there is more nuanced than either the doomsellers or the cheerleaders will tell you. For most Americans over 50, the house is not just shelter. It's the savings account that worked. It's the asset that, almost by accident, did what the stock market promised, but rarely delivered cleanly. It went up year after year while you lived inside it. According to Federal Reserve data, home equity represents the single largest component of net worth for households in the 55 to 74 age bracket. For many families, it's worth more than the 401k, the IRA, and the brokerage account combined. Which means if you don't understand what's happening to housing right now, you don't understand what's happening to your wealth. Let me start with what's true, before we get to what's changing. Between 2010 and 2022, American home prices roughly doubled in many markets. Some places, Boise, Austin, Tampa, Phoenix, saw gains of 150% or more. This wasn't because the houses got better. The same 1,800 square foot ranch with the same kitchen and the same roof was suddenly worth twice as much. Why? Two reasons, and they're inseparable. First, mortgage rates fell to levels that had never existed in American history. In January 2021, you could borrow money for 30 years to buy a house at roughly 2.65%. That number is so low, it almost doesn't compute. To put it in context, your grandparents probably paid 8, 9, sometimes 12% on their mortgages. Your parents likely paid 6 to 8%. You may have refinanced into a 3% loan and thought you were a genius. You weren't a genius. You were lucky enough to be alive during the cheapest decade of borrowed money in modern human history. Second, when borrowing is that cheap, the math of what can I afford changes dramatically. A family earning $95,000 a year can suddenly afford a $480,000 house instead of a $320,000 house, because the monthly payment is the same. Multiply that across millions of buyers competing for a limited supply of homes and prices go vertical. They have to. It's arithmetic. Now reverse the engine. By late 2023, 30-year mortgage rates in the United States had climbed above 7%. As of 2026, they've been hovering in a range that, while down from the peak, is still roughly 2.5 to 3 times what the lucky refinancers of 2020 and 2021 locked in. That same family earning $95,000, their buying power has been cut by something like a third. The $480,000 house they could afford in 2021 is now, in monthly payment terms, more like a $315,000 house. Here's where the Japan connection comes back, and where most homeowners over 50 are not connecting the dots. Mortgage rates in the United States are not set by the Federal Reserve directly. The Fed sets the short-term rate. Mortgage rates are tied much more closely to the 10-year Treasury yield. That same Treasury yield that has been quietly held down for 30 years, partly because Japan, China, and other foreign holders kept showing up to buy. As that bid weakens, as Japanese pensions repatriate capital, as the global cost of money resets upward, the 10-year Treasury yield has structural pressure to stay higher than it was in the 2000s. Which means the era of 3% mortgages isn't coming back the way most people quietly assume it will. I'm going to say that again because it's the single most important sentence in this section. The era of 3% mortgages isn't coming back the way most people quietly assume it will. This has 3 consequences for someone in your stage of life, and I want to walk through each one honestly. First consequence, your home is harder to sell at the price you think it's worth. Not impossible, not crashing, harder. Because the pool of buyers who can afford your asking price has shrunk. The 35-year-old couple that would have qualified for your $620,000 house at 3% now qualifies for roughly $420,000 at 6.8%. They want your house. They can't afford your house. That gap doesn't close overnight, and it doesn't close by waiting. It closes either by your price coming down or by their wages going up substantially, or by rates dropping substantially. And only one of those three is in your control. Second consequence, if you were counting on downsize and pocket the difference as a retirement strategy, the math is thinner than your projection assumed. Let's say you plan to sell the $620,000 house, buy a $380,000 smaller home in a lower cost area, and net $240,000 to add to your retirement. In a softer housing market, you might net $190,000. In a meaningfully softer one, $150,000. The strategy still works, but the cushion is smaller, and most retirement plans I've seen don't stress test that assumption. Third consequence, and this is the one almost nobody talks about, your home equity line of credit, if you have one, just became a different instrument. HELOCs are typically tied to short-term rates. When rates were low, that line of credit you opened just in case felt like a free option. At today's rates, drawing on it is expensive. For some homeowners, the HELOC they were quietly counting on as an emergency fund is now an emergency liability waiting to happen. Now let me give you the honest counterweight, because this channel doesn't trade in half-truths. American housing has real durable demand. The country still underbuilt homes for 15 years after the 2008 crisis. Millennials, the largest generation in U.S. history, are still in their peak home buying years. Immigration on net adds household formation. The supply-demand imbalance is real and isn't disappearing in 18 months. So I'm not telling you your house is going to crash. I'm telling you that the tailwind that doubled its price in 12 years is no longer blowing in the same direction, and you should not plan your next decade as if it is. Imagine a couple, Tom and Linda, 61 and 59. They own a paid-off house in suburban Atlanta, currently appraised at $580,000. Their retirement accounts hold $610,000. On paper, they're worth nearly $1.2 million. They feel comfortable, and they should. They did the work. But the plan their advisor showed them assumes they can sell the house in 5 years for somewhere around $720,000 based on historical appreciation. That projection was built on a 40-year tailwind that's now turned. A more honest projection might put that future sale price closer to $620,000 to $660,000. That's a $60,000 to $100,000 gap between the plan and the more realistic outcome. Not catastrophic, but not nothing, especially when you're trying to fund 25 to 30 years of retirement. If you fix this assumption, if you build your plan around what's likely instead of what's hoped, everything changes about how aggressive you can be in the next 10 years, how much you need to save, and when you can actually stop working. In the next section, I want to take you into the most under-discussed risk on the table. What happens to the US dollar itself when the global money flows that supported it for 30 years start to reverse? Because if you've ever wondered why a gallon of milk that cost $2.79 in 2019 now costs $4.40, the answer is not just inflation. The answer involves the architecture of who holds dollars, why they hold them, and what changes when they decide to hold a little less. There's a question I want you to sit with for a minute, because the answer is more interesting than the official explanation. In January of 2019, A gallon of whole milk at the average American supermarket cost around $2.90. In 2026, that same gallon costs somewhere between $4.20 and $4.60 depending on where you live. A dozen eggs that cost $1.80 now costs $3.50 or more. A standard homeowners insurance policy that ran $1,400 a year in 2019 now runs $2,300 in many states. Your grocery bill, your utility bill, your car insurance, your property tax, every one of them has climbed, and not by a little. The official answer is inflation, which is true, the way weather is true when someone asks you why it rained. It's a label, not an explanation. The deeper answer involves what your dollar actually is, and why it has held its value as well as it has for as long as it has. And once you understand that, you understand why the next 10 years are going to feel different in a way that no government statistic will fully capture. Let me show you the blueprint. The US dollar is the world's reserve currency. That phrase gets thrown around so often that most people stop hearing it. So let me translate it into what it actually means for your wallet. When a Brazilian company sells coffee to a German buyer, they typically settle the transaction in dollars. When Saudi Arabia sells oil to Japan, the contract is in dollars. When a central bank in Indonesia or South Africa or Poland wants to hold savings, what's called foreign reserves, they hold a big chunk of it in U.S. Treasury bonds denominated in dollars. Roughly 58 to 60% of all global foreign reserves, depending on the year and the source, are held in U.S. dollars. No other currency comes close. The euro is a distant second. Everything else is rounding error. This is not a coincidence, and it's not because the world particularly loves America. It's because of trust, depth, and habit built over 80 years since the Bretton Woods Agreement of 1944. The world uses the dollar because the dollar works, because U.S. Treasuries are the most liquid asset on earth, because the American legal system, however imperfect, has historically honored contracts. And here's the part that almost no one explains to ordinary Americans, that global demand for dollars has been a massive, ongoing subsidy to your standard of living. Think about what it means to live in a country whose currency the entire world wants to hold. It means there is constant structural demand for dollars beyond what Americans themselves create. Foreigners need dollars to buy oil, to settle trade, to park their savings. Every one of those transactions is, in a sense, a small loan from the rest of the world to the United States. It lets the U.S. government borrow more cheaply than any other country. It lets American consumers buy imported goods at prices that in real terms are lower than they would otherwise be. It lets your retirement savings, denominated in dollars, hold their value against the rest of the world in a way most other currencies cannot. This is why your iPhone, manufactured halfway around the world with components from a dozen countries, can cost $999 instead of $1,800. This is why a Toyota Camry, built partly in Japan, partly in Kentucky, partly with parts from Mexico, sells in the United States for a price an American household can actually afford. The dollar's reserve status is a financial superpower that most Americans have never been asked to think about, because it has worked silently in the background of their entire lives. Now here's where Japan re-enters the story. Japan has been one of the largest foreign buyers and holders of dollar-denominated assets for the past 30 years. Not just U.S. Treasuries, corporate bonds, American real estate, American stocks, American agricultural land, trillions of dollars in aggregate parked in dollar-denominated assets because the math worked. Japanese investors got better yields, the dollar held its value, and the carry trade, borrow cheap yen, buy dollar assets, was profitable. Every one of those purchases supported the dollar. Every one of them was, in effect, a vote of confidence in the American financial system. When that flow reverses, when Japanese pension funds, insurance companies, and banks start sending capital home because Japanese yields are finally competitive and the yen is structurally weak, the support for the dollar at the margin gets thinner. Not gone, thinner. And thinner support at the margin is exactly the kind of slow structural change that doesn't make headlines but quietly reshapes purchasing power over a decade. This is where most people get it wrong. They hear, the dollar is weakening, and they picture a sudden collapse, a hyperinflation event, bread lines and wheelbarrows of cash. That is not what's happening. And I'm not going to insult you by pretending it is. What's happening is more subtle and in some ways more insidious. A gradual erosion of the dollar's purchasing power against real goods, food, energy, housing, healthcare, that compounds quietly over years. Let me put a number on it that you can actually feel. If your purchasing power erodes at, say, 3.5% per year, which is below the inflation peaks of 2022 and 2023, but above the Fed's official 2% target, then over 10 years, a dollar buys roughly 30% less than it does today. A retirement nest egg of $800,000 in today's dollars is worth, in real purchasing power, closer to $560,000 in 2036 dollars. The number on the statement looks the same, or even bigger. The life it can buy you is meaningfully smaller. This is the part that retirement calculators tend to fudge. They assume inflation at 2.5% because that's what it averaged for decades. But the decades of low inflation were partly an artifact of globalization, cheap energy, cheap Asian manufacturing, and a dollar so dominant that imported goods stayed cheap. If those tailwinds soften, if energy is structurally more expensive, if supply chains are partially reshored at higher cost, if the dollar's global demand at the margin weakens, then the inflation rate that retirees actually experience may run a full percentage point or more above what their plan assumed. A full percentage point over 25 years of retirement is not a rounding error. It's the difference between running out of money at age 88 and running out at age 82. Imagine a single woman, Diane, 63 years old, planning to retire next year. She has $640,000 saved. Her financial advisor's software, using a 2.5% inflation assumption, tells her she can safely withdraw $32,000 a year for 30 years and have a high probability of not running out. Diane feels reasonably secure. But if the actual inflation she experiences over the next 30 years runs at 3.5%, not catastrophic, just somewhat higher, that same $32,000 withdrawal rate runs out of room roughly 6 years earlier than the projection promised. At age 87 instead of 93, the well is dry. Diane is still alive. The money isn't. You don't need more money. You need a better plan. And a better plan starts with refusing to use inflation assumptions built for a world that no longer exists. This isn't about hoarding gold or buying canned beans. It's about understanding that the purchasing power of your savings is not a fixed thing. It's a moving target, shaped by global capital flows you didn't know existed, supported by structural advantages that are slowly thinning, eroded by an inflation rate that may run hotter than your plan assumes. And the people who quietly understand this, the ones who reposition their assets, who think carefully about inflation-protected income streams, who rebuild their plans on honest assumptions, are going to navigate the next 20 years very differently from the people who don't. In the next section, I'm going to take you into the part of this story that almost nobody is willing to talk about plainly. What happens to Social Security, Medicare, and the federal budget itself when the cost of servicing the U.S. national debt rises in a world where Japan and other foreign creditors are no longer the eager buyers they once were? Because if you're counting on those programs to anchor your retirement, and most Americans are, in some form, you need to understand the pressure they're about to come under. There is a number in the United States budget that almost no one talks about at family dinners, and yet it touches every Social Security check, every Medicare benefit, every dollar of federal spending you have ever depended on or ever will depend on. In fiscal year 2024, the U.S. government spent more on interest payments on the national debt than it spent on the entire defense budget. Let that sit for a second. The country that maintains the most expensive military in the history of the world spent more money paying interest to bondholders than it spent on aircraft carriers, fighter jets, military bases, and 1.3 million active duty service members combined. Interest payments crossed roughly $880 billion that year, and they have continued to climb. By 2026, by most credible projections, that number is approaching, or has already exceeded, $1 trillion. $1 trillion in interest every year, just to service debt that was largely accumulated at much lower interest rates than the country now faces. This is where most people get it wrong. They assume the federal government can simply print money to cover any shortfall. They assume interest payments are some abstract Washington problem that doesn't touch them personally. They assume Social Security and Medicare exist in a separate compartment, safe from whatever is happening in the bond market. None of that is fully true, and the connection to what we've been discussing, Japan, the carry trade, the global price of money, is more direct than the political class is willing to admit. Let me walk you through the mechanics, because once you see it, you can't unsee it. The U.S. government, like a homeowner with a mortgage, doesn't pay off its debt. It rolls it over. When a 10-year Treasury bond comes due, the Treasury Department doesn't typically write a check from existing cash. They issue a new bond, sell it to investors, and use the proceeds to pay off the old one. This is normal. Every major government does it. It works fine, as long as new investors keep showing up at reasonable interest rates. For roughly 30 years, Japan was one of those reliable buyers. So was China. So were oil-exporting nations parking their dollar earnings. So were European pension funds. The auction was crowded. The U.S. could borrow at 2%, sometimes lower. Interest payments stayed manageable as a share of the federal budget. Now imagine that same auction with fewer foreign buyers, and the ones who do show up demanding higher yields because their own home markets Japan especially, finally offers something competitive. The U.S. Treasury still has to roll the debt. Roughly 30% of all outstanding U.S. government debt comes due within the next 12 months and has to be refinanced. Another large chunk matures within 3 years. Old bonds issued at 1.5% are being replaced right now with new bonds issued at 4.2, 4.5, sometimes higher percent. The interest bill compounds, quietly, mechanically, year after year. By 2030, by credible Congressional Budget Office projections, federal interest payments could approach or exceed $1.6 trillion annually. To put that in proportion, total annual Social Security payments to retirees currently run around $1.5 trillion. Total Medicare spending runs around $900 billion. We are heading toward a near-term reality where the government spends more on interest than on the entire retirement program that most Americans over 50 are counting on as the foundation of their old age. You see the pressure point now, don't you? When interest costs eat that much of the federal budget, something has to give. The math is not optional. There are exactly 4 levers a government can pull, and every honest analyst, left, right, or independent, knows it. The political theater is about which lever, in what order, and how loudly to admit it. The levers themselves are not in dispute. Lever 1 is raising taxes, not just on the rich. That math doesn't close the gap by itself, regardless of what any political ad tells you. Broader-based taxes, in some form, eventually have to be on the table. That hits working Americans, including retirees with taxable accounts. Lever 2 is cutting spending. The 2 largest items in the federal budget, by a wide margin, are Social Security and Medicare. Cutting defense, cutting discretionary programs, cutting agency budgets, even all combined, does not close the gap. The honest math eventually points at the entitlements. Lever 3 is letting inflation quietly erode the real value of the debt. This is the lever governments have used throughout history. You don't default. You just pay back the bondholders in dollars that are worth less. The bondholders get their money. The retirees, the savers, the people on fixed incomes, they get a slow, grinding loss of purchasing power. This is the lever that hurts your generation the most because you have less time to recover. Lever 4 is some combination of the first 3. This is what actually happens in real life. Always. Now connect this back to Japan. When the world's 3rd largest economy stops being a reliable, low-cost lender to the United States, when Japanese pensions repatriate, when the carry trade unwinds, when Japanese long-term bonds offer 4% and the yen is weak, the U.S. Treasury has to find replacement buyers. Those replacement buyers will lend, but at higher rates, which means interest costs climb faster, which means the 4 levers come into play sooner than the official projections suggest. This is not a forecast of doom. The U.S. is not Greece. The U.S. is not Argentina. The dollar's reserve status, the depth of American capital markets, the size and dynamism of the U.S. economy, all of these are real and durable advantages that buy the system time. But buying time is not the same as no problem. The pressure is real, the math is real, and the people who will feel it first and hardest are people in your stage of life. Those who built their retirement plans around assumptions about Social Security cost of living adjustments, Medicare coverage, and stable federal tax rates that may not hold the way they did for the last 30 years. Let me give you a specific example. Imagine Robert and Susan, both 64, planning to claim Social Security at age 67. Their projected combined benefit, based on current rules and current cost of living adjustment formulas, is roughly $58,000 a year. Their advisor has built their entire retirement plan around that number, adjusted upward each year by an assumed 2.4% COLA. But if the federal government, under fiscal pressure, modifies the COLA formula, as has been quietly proposed in Washington for over a decade, to a slightly less generous index, that $58,000 grows more slowly. Over 20 years of retirement, the cumulative difference could be $90,000 to $140,000 in real purchasing power lost. Not because anyone cut their benefits in the dramatic political sense. Just because the formula was adjusted, quietly, in the small print of a budget reconciliation bill. The check still arrives every month. The check buys less. Or imagine Medicare. The program currently covers, depending on the analysis, somewhere between 60 and 70% of the actual medical costs a typical retiree faces over their lifetime. Premiums, deductibles, prescription drugs, dental, vision, hearing, and long-term care fill the rest of the gap out of your pocket. Under fiscal pressure, those gaps tend to widen, not narrow. The 30 to 40% you're already responsible for may climb to 40 or 50% over the next decade. If you fix this assumption, if you build your plan around what's likely instead of what's promised on the brochure, everything changes about how much you actually need to have saved, how much income protection you need, and how aggressive your withdrawal rate can responsibly be. Now, I want to be honest about one more thing before we move on. I am not telling you Social Security is going to disappear. I am not telling you Medicare is going to vanish. The political reality is that these programs are too central to too many lives to be abolished. But won't be abolished is a long way from will deliver exactly what your projection assumed. The middle ground, slow erosion through formula changes, premium increases, coverage gaps, and inflation that outruns the COLA, is where most of the actual damage happens and where most plans don't stress test. In the next section, I want to bring this entire framework together and show you the specific moves that thoughtful Americans over 50 are quietly making. Not the doom prepper stuff, not the gold bug stuff, but the practical, evidence-based repositioning that gives you durable footing in a world where the old assumptions no longer hold. And I'm going to ask you for something small in return. Because if you've come this far with me, you already know this channel doesn't waste your time. Before I give you the practical framework, I want to ask you for something small. If you've come this far with me through the carry trade, through Japan, through bonds and housing and the dollar and the federal debt, you already know this channel doesn't trade in fear. We trade in honest math and respect for your time. If that has any value to you, take 2 seconds and hit the subscribe button. Not because I need it, because the next videos in this series, the specific moves for inflation-resistant income, the truth about annuities the industry doesn't want you to hear, and the framework for stress testing your retirement plan against the actual world we live in, those will land in your feed only if you're subscribed. 2 seconds. That's all I'm asking. Then come back. because the next part of this video is where the entire framework becomes actionable. Welcome back. Now let's talk about what thoughtful, well-informed Americans over 50 are actually doing, because I want to draw a clean line between two very different camps. Take your current retirement plan. Take the number your advisor's software shows you, the one that says you're on track, or 84% confident, or whatever cheerful phrase the software produces. Now ask one question. What happens to this plan if inflation runs at 3.5% instead of 2.5%? If my home appreciates at 2% instead of 4%? If Social Security delivers 90% of what's projected, and if my health care costs come in at the high end of the estimates? Run that scenario. Look at the number that comes out the other side. That number is much closer to the world we're actually entering than the cheerful baseline. If that stress-tested number still works, if you'd still be okay, then you've earned the right to relax. You've built a real plan. If that stress-tested number doesn't work, you haven't failed. You've just discovered something useful 7 or 10 or 15 years before retirement when you still have time to adjust. That's the entire purpose of this exercise. Not to scare you, to give you back the years you need to act. This is the blueprint, not a single tactic, a framework. Recalibrate honestly. Build income, not just assets. Preserve geographic and lifestyle flexibility. Take healthcare seriously and stress test against the world that's actually arriving, not the world that's leaving. Imagine a final couple, Mark and Elaine, both 57. They have $540,000 in retirement accounts, a paid-off home worth $510,000, and a plan their advisor says is on track. When they ran the honest stress test, the projection that said they could retire at 65 actually showed them needing to work until 68, save an additional $1,400 a month, or accept a 12% lower retirement income than they'd assumed. Uncomfortable to learn. Genuinely useful to learn at 57. At 67, with the same information, the options would be far narrower. That's the difference between knowing the blueprint and not knowing it. 11 years of runway versus 1 year of panic. The math is the same. The time available to act is everything. In the final section, I want to leave you with something I think about often, a way of looking at the next 20 years that I hope stays with you long after the screen goes dark. There's a scene I want you to carry with you after this video ends. It's a Tuesday morning, 10 years from now. The year is 2036. You're standing in the kitchen of your home, holding a cup of coffee, looking out the window at a backyard you've owned for 2 decades. The sun is coming up. The house is quiet. You're somewhere between 60 and 75 years old, depending on where you are right now in the arc of your life. I want to show you 2 versions of that morning, because every choice you make from this point forward is quietly choosing between them. In the first version, you wake up that Tuesday with a low, persistent anxiety that you can't quite name. You retired 4 years ago. The number on your retirement statement looked fine when you stopped working. But something has been wrong with the math for a while now. Your grocery bill, which was $640 a month when you retired, is now $890. Your homeowner's insurance, which was $2,100 a year, is now $3,400. The Medicare supplement plan you thought was solid had a premium increase last year that you weren't expecting. Your Social Security check, in dollar terms, is bigger than it was 4 years ago, but the cost of living adjustments have run consistently below the inflation you actually feel. You've quietly started skipping things. A dinner out here, a trip you'd plan to take, a small repair on the house that can wait another season. Each individual cut is manageable. The accumulation of them, over 4 years, is the slow unraveling of the life you thought you were building. You're not poor. You're not in crisis. You're just smaller than you imagined you'd be. And the worst part is, you're not sure exactly when or how it started. It just did. In the second version, you wake up that Tuesday with something different. Not wealth necessarily. Not the absence of worry. That's not a real thing at any income level. But durability. A sense that the ground under your feet is solid because you built it that way. You stress-tested your plan a decade ago when you were 58. You found gaps. You closed them. You restructured part of your portfolio for inflation-adjusted income. You ran the numbers on geographic flexibility, decided to stay where you were, but knew you could move if you needed to. You took healthcare planning seriously. You stopped using your advisor's cheerful baseline projection and built a more honest one. You made small adjustments over many years instead of large ones in a crisis. And now, that Tuesday morning, looking at the same backyard, you have a different relationship with the future. You're not bracing. You're living. Both of those mornings are real possibilities. Both of those people in 2036 are you. The only variable is what you do with what you now know. I want to ask 3 things of you before I let you go. First, if any of what I shared tonight made the world a little clearer, even uncomfortable, even hard to hear, hit subscribe. Not as a favor to me, as a signal to yourself that you want to keep thinking carefully about the next 20 years of your financial life instead of drifting through them. Second, share this video with 5 people who matter to you, not your whole contact list. 5. The 5 people you'd actually call if you needed honest counsel. A sibling who's also in their 50s. A friend approaching retirement, a coworker you trust, the neighbor whose kids grew up with yours, the people in your life who deserve to see the financial weather changing before it changes them. Send it to them tonight. 1 text each, 5 texts. That's the entire ask. Third, leave a comment below telling me one specific assumption inside your retirement plan that you now suspect is too optimistic. Inflation, home value, Social Security, healthcare costs. Whichever one struck you, just name it, because I read those comments and they shape what I cover next, and because naming something out loud is the first move from passive worry to active planning. Here's the last thing I want to leave you with. The financial industry has spent 40 years selling Americans on a single, beautiful, dangerous idea: that retirement is a destination, a number you hit, a door you walk through, a finish line. It isn't. It's a relationship between the money you've saved, the world you actually live in, and the time you have left to be alive in it. The people who navigate that relationship well aren't the ones with the most money. They're the ones who told themselves the truth early enough to act on it. You just heard the truth. Now you have time. Use it.